After risk has been identified, the second and one of the most important phases is assessment. So remember, first you identify, then you assess the risk. What is risk assessment? How can you assess or analyze the risk? This can be done quantitatively by using numerical data, quantitatively, or qualitatively by using expert judgment to understand the impact. So quantitatively, you're using numerical data, you're using quantity, something that you can measure. Qualitatively, you're using quality, you're using judgment, expert judgment. The impact could be financial, could be operational, and more. So you can do an ad hoc assessment. So this is conducted on an unneeded basis. And this is usually in response to specific incidents or emerging threats, for example. This is usually less structured and it doesn't follow a predefined schedule. This focuses on immediate identification and mitigation. It's an ad hoc process and it's not usually used in organizations. Recurring is regularly scheduled assessments, like manually, like quarterly, annually, to continuously evaluate and manage risk. So it's on a recurring basis. It's on a schedule, and this ensures that the risk management practices are up to date and aligned with the business and threat landscapes. One time is conducted for specific projects or initiatives, like so one-time analysis, like providing a snapshot of a particular point in time. This is usually for maybe new projects, if you have a merger with another organization, or if there's a significant change in the business operation. And continuous is the best way to go about that. This ongoing risk assessment integrated into daily operations and decision-making. And it uses automated tools and real-time monitoring to identify and dynamically respond to risk. This is the best way to go about risk assessment, continuously assessing. Now, we talked about quantitative and qualitative analysis. What are these? So these are two ways to assess risk in an organization. You can assess risk quantitatively or qualitatively. In quantitative analysis, you're assigning numerical values to risk and usually involves money, like the probability of occurrence and how much money could be lost. That's quantitative analysis. In qualitative analysis, this involves subjective assessment. It's based on judgment and experience. It doesn't assign any numerical values, but it uses descriptive terms. For example, here you have like how probable was the probability and the impact. It could be severe, it could be minor, it could be moderate, it could be major. So you are using quality and expert judgment. There is no actual measurement, no actual numbers in qualitative analysis. Meanwhile, in quantitative analysis, you're using numbers. So here's a few examples. Here are a few examples of quantitative analysis. There is something called Single Loss Expectancy, SLE. Very important acronym. Take note of the acronyms on this slide and on the next slides. SLE, Single Loss Expectancy. This is the expected monetary loss on one event. So this is the monetary value assigned to an event and represents the potential amount if a negative event occurs. Imagine that you're selling servers and that someone steals a server and the server costs $10,000. That's the single loss expectancy. So if the server is lost, if the server is stolen, if it crashes and it's not able to operate anymore, that's $10,000 lost. That's a single loss expectancy, SLE. The annual rate of occurrence measures how often an event can happen in a year, how many times a negative event can happen in a year. For the stolen server that we talked about, $10,000, if you expect that 5 servers are stolen or crash completely per year, like are damaged, that's 5 times. The rate of occurrence is 5. Annual rate of occurrence, ARO, that's 5. So single loss expectancy, money loss for one event. Annual rate of occurrence, how many times it could happen in a year. Now, the annual loss expectancy is the financial impact of a risk over the course of a year. And the formula is ARO times SLE. So for the servers, for example, that if they are damaged 5 times in a year, that's the annual rate of occurrence. And every time one of the servers is damaged, that's $10,000 you lost. Then the annual loss expectancy is $50,000. 5 times $10,000. Another example, suppose you expect a ransomware attack on your organization 2 times per year, And every time your organization is under a ransomware attack, it costs $75,000 to repair servers and recover your data. And what will be your annual loss expectancy? Your ARO is 2 because you expect 2 times ransomware per year. Your single loss expectancy, $75,000. So your annual loss expectancy will be $150,000. That's quantitative analysis. You're measuring risk with value, with monetary value, with actual value. More examples. Suppose there is a fire in a warehouse and this causes $37,500 in damages, and that the frequency of a fire taking place is once every 10 years. What is the annual loss expectancy? So annual loss expectancy is single loss expectancy times annual rate of occurrence. But here's the thing. We said once every 10 years. So in 1 year is 1 over 10. So it's 10% or 0.1. So the answer is $3,750 because loss for a single event is 37,500, but the loss in 1 year is 1 divided by 10, so 0.1. So that's your annual loss expectancy, $3,750, because the ARO is a value of 0.1. So the ALE, annual loss expectancy, tells the organization that if he wants to put controls to protect the asset, in this case, the warehouse, from the threat, which is a fire, then he can spend $3,750 or less per year to provide the protection, not more. At most, that amount it should spend per year. So a few terms that we mentioned, we talked about likelihood. Likelihood is the chance of an event happening. It can be low, medium, or high. And this is used to influence the prioritization and mitigation strategies. If a risk is high, you want to put most of your resources to protect against that risk. If it's low, you can play around and disregard that at first. There is exposure factor, EF. Exposure factor is a percentage of asset value that is at risk due to a specific threat. So this is also used to calculate potential losses. And we will do an exercise on exposure factor. So the single loss expectancy, in effect, is the exposure factor times the asset value, times the value of the asset. So SLE is EF times AV. What is the percentage of the asset exposed? For example, if you get an example that says only 10% of a warehouse is exposed to a fire, for example, that means the exposure factor is 0.1 or 10%. And if you get, and then they tell you that the asset value, they'll give you the value. So from there, you can calculate the single loss expectancy. Now the impact. What is the potential consequence of a risk event? What is the reputational impact? This is very critical for understanding the severity of the risk and also prioritizing your responses. For example, Macy's operates an online retail platform that processes customer transactions. They're assessing the financial impact of credit card fraud incidents. First, you're given 30% of transactions are lost due to fraud, $500,000, the average value of transactions processed annually. Fraudulent transactions occur approximately once every 10 years. So first, you want to calculate the exposure factor, 0.3, that's 30%. That's the number of transactions lost. The exposure factor is 30%, which means that it's not every transaction that's lost. It's only 30% of the transactions. And you're given the value. The asset value is $500,000. And the annual rate of occurrence is 0.1. So now you have these given statistics, you have them written down. So remember, we want the annual rate of occurrence. First, you have to calculate the single loss expectancy. Single loss expectancy is exposure factor times the value of the asset. So how much monetary value will be lost in a single event? It's not the $500,000. Why? Because it's not all of the $500,000 that is lost. The amount of data that's exposed to loss is only 30% of that. So we have 0.3 times $500,000. So the single loss expectancy is $150,000. This is the monetary loss for each incident, for one incident, because only 30% of transactions are lost. So it's not the entire $500,000 that you're losing. Now, the annual loss expectancy is the loss due to one single event times the number of times it could happen. So they said once every 10 years, so that's 0.1. So then your annual loss expectancy is $15,000. So this represents the monetary loss per year. So Macy's, in this case, shouldn't invest more than $15,000 to protect their transactions per year. Now, this is just an example. These numbers are very inaccurate from what actually happens at Macy's. The goal is just for you to understand how these numbers are operated. Now, important concept is that of a risk register. What is a risk register? This is a documented repository to record information about identified risks. So the risks affecting an organization are documented and they're managed. And this is what it could look like. First, the risks identified, and then you categorize them, and then you give them a probability and an impact and a severity score. Then you define them even in more detail with the what does the score mean? What could be some potential response plans and mitigation plans? What could trigger the risk? What's the likely timing of the risk, and more. This is just a quick example, but you need a risk register. What are key risk indicators? These are metrics used to signal changes and monitor changes in risk level. So this helps in identifying and manage risk. These are KRIs, key risk indicators. Who are the risk owners? These are individuals or teams responsible for managing specific risk. This is for accountability. You don't just want the risk to be managed by anybody. And what's the risk threshold? This is the level of risk that an organization is willing to accept before they take action. Now, what is risk appetite? Risk appetite is the level of risk that an organization is willing to accept. Can an organization completely deny risk, or can they accept at least a specific level, provided that it will not disrupt the entire organization? That's what we talk about risk appetite. There's a balance between pursuing your activities and what could be the effects of accepting certain level of risk. Risk tolerance, a company might specify that it can tolerate up to 25% market downturn before taking action. So it really depends on the organization, what they're willing to accept and what they cannot accept. So you have risk tolerance and risk appetite. Now, risk appetite can be expansionary. So this means that the organization is willing to take on higher risk to pursue growth opportunities. So it's expansionary. The organization is willing to that. And this focuses on innovation, market expansion, and competitive advantage. For example, an organization says that their company has an expansionary risk appetite. They're willing to take calculated risk to enter new markets, to develop new products, and pursue new growth opportunities. They understand that this may involve higher financial and operational risks, but they want to achieve substantial market share and revenue growth. So they might tolerate higher levels of leverage, invest significantly in R&D, and expand in its market presence, even though it exposes them to more risk, for example, but they continue. It can be conservative. So risk appetite can be conservative. So you prefer to minimize the exposure to risk and you prioritize stability and security, not the company growth. You emphasize risk-averse strategies and compliance with regulations. So this is, for example, an organization says they prioritize stability and long-term sustainability over aggressive growth. They want to be cautious in their financial decisions. They want to maintain a steady cash flow. They want to minimize debt and ensure profitability. They want to avoid high-risk investments and maintain low level of debts, for example. And it can be neutral. So neutral maintains a moderate approach. It balances risk-taking and risk avoidance. Maintains a moderate approach. It adopts flexible strategies that can adapt to changing conditions. They can engage in moderate levels of R&D, strategic partnerships. They carefully assess the market risk and they adjust investments based on industry developments.
All right, guys, was that interesting? If so, then subscribe to our YouTube channel and also follow us on all our social media platforms, including Instagram, Facebook, Twitter, LinkedIn, to know more and be the first people to see our amazing content that we have for you. Thanks, guys. We're glad to have you.